So we've talked about the 4% rule before, which is the idea that a retiree can withdraw 4% of a portfolio's original value and still be reasonably certain that their money will last as long as they do. Whether that works or not depends on many different factors, but it's a guideline that could be a decent starting point for someone looking to fund 30 years worth of retirement from, say, 65 to 95. But what if you're a lot younger than that, maybe in your early 40s or even younger, and you'd like to retire at that age? Hey, it can happen under certain circumstances, and God bless you if it does. But how well does this so-called 4% rule hold up in that case? So let's assume you're 40 years old and you decide you need $100,000 of annual income with a 3% adjustment for inflation each year. That would mean that you need a $2.5 million nest egg, which at a 4% withdrawal rate gives you the $100,000 that you're looking for. So what could go wrong? Well, a lot, as it turns out. First, your money has to last not for 30 years, but 55 years. And if you're taking systematic withdrawals of your portfolio with, say, a 60-40 mix of stocks and bonds, if the market performs poorly through the early years of your retirement, your money could very quickly run out. That's called sequence of returns risk. So next, what if interest rates, and the economic growth remain low? We could be facing lower market returns than we've seen in the past. If your money needs to last 50 or more years, market returns become even more critical. Third, with so much time ahead, you've got greater risk of unexpected spending shocks like health insurance or large home repair. These things can really eat into your nest egg. And at age 40, you're also 25 years away from Medicare, which means you've got to fund your own healthcare needs. And that's not cheap. All of this means that 4% withdrawal rate may be far too aggressive the younger you are when you retire. In fact, an analysis by the Capital Group companies determined that the maximum safe annual withdrawal rate for a 40-year-old is roughly 3.38%, and it goes down to 2.79% if you factor in spending shocks and lower future market returns. So keep this in mind if you want to retire early. With a longer retirement to fund for, there's potential for a lot more uncertainty. This is yet another reason to talk with a financial advisor and to have a strategy.